Is it 1998 or 1999? Or does it matter? Now, if you go back to that time period, you can remember that the market was extremely overvalued at the time. A lot of investors said, well, we're not comfortable with being in the market, but it kept on rallying harder. There's a lot of comparison today to that time period as well. So we're going to talk about that in this newsletter. So, I start off in here. I've actually got that 1988 or 1999 on the first page here. But before that, I've got this picture of someone holding their nose. Now, before I get into this is the Thackray's October newsletter. This video is meant to complement the actual newsletter, so I'm going to explain a few things along the way, add a little bit as well. It's not meant to replace the newsletter, but to add to it. So this picture here basically is you have to hold your nose sometimes and just do it, is what I say right here. And what this applies to is we've seen the market really strong in the summer months. And that's not normal from a seasonal viewpoint. In fact, it's extremely rare unless you're coming out of a recession, which we're not. But does that mean you adjust the seasonal trends and say, well, because this happened, therefore I'm not going to be going back into the market in late October or start to increase my equity allocations, etc. I think it's important to follow your seasonal discipline or whatever discipline you're following and not make on-the-adjustment fly. Sure, you can do some reviews and make some adjustments. But just because we've seen the market perform well over the last few months does not mean it's about to underperform over the next few months as well. And I think it's important to follow an investment discipline. On the next page here, I've got this. I've actually got this book as well. It's called Irrational Exuberance. It's by Robert Shiller. Now, this was based upon a phrase that at the time Greenspan mentioned in 1997, I think it was, that the market is crazy, it's overvalued. And we saw the market sort of buckle for a couple of days and then move higher, and much higher again. And really, it's the market isn't a beast by itself. So yes, it can be overvalued and there can be irrational exuberance and it can continue for a long time. Now, I've got a picture down here of Paul Tudor Jones, and this is he gave an interview on CNBC, and he talked about, well, are we in 1998 or 1999? And I think there are some differences, by the way, compared to where we were back in the 1999 and going into the tech bubble burst, basically. First of all, I talk about how that tech companies today are different. A lot of them are actually making money. Some, you might say, well, maybe there's some funny, shady stuff going on here. But overall, we see more tech companies making more money as well. As well, governments are actually really stimulating the economy here, but they keep just spending money as well at the same time, which is a big difference as well. And we're seeing interest rates being cut here that the Federal Reserve wasn't doing coming into the tech bubble. They were raising rates consistently over time to try and slow the economy down. This is not what's taking place now. So there are some tailwinds. So maybe there is a bit of a correction, but we do have some tailwinds as well, even if the market is overvalued and does correct. Now, I want to talk about earnings for a second here. Q2 earnings were actually quite good. We saw the earnings up 13.8% on a year-over-year basis, so better than expected. So we are seeing earnings still solid at this time. We can argue about there's certain parts of the economy that are really showing strain, but if we actually measure on earnings are still doing well at this time. The next part of the newsletter, so overall, the fundamental backdrop for the market from the headline level is still fairly good. We talk about inflation, we talk about GDP growth in the U.S. It's still good. Earnings are still good. So from that level, it still looks to be fairly solid. But there's a lot of underlying indicators in the labor market and trucking, et cetera, that say, hey, the economy is slowing down. We just haven't seen it show up yet. Next part of the newsletter I talk about is Japan. Now, I've done this before, and most investors aren't interested in markets outside of the U.S. They say, tell me about the Canadian stocks or ETFs or the U.S. ETFs. But I think this is really important to follow some of the other countries at this time because of what's taking place. And I've done this before as well. I did a video on why Japan could be the next black swan. That was quite a while ago. It still could be as well. In fact, here I did this video. You can see here, if you go to the my YouTube channel at Brooke Thackray, you'll be able to see this in the shorts section because it was a short video, basically. And I just go through and talk about, well, they just elected a new leader that's likely to take over as prime minister. And guess what? The solution to their problems is more government spending. You have to wonder. We have a debt problem. We have a 250% debt to GDP. And yes, let's increase the debt level. This is not the solution. But governments all over the world think that spending more money is the solution. And the result is we're seeing this take place. We're seeing the yield on the Japanese long-term bond increasing dramatically. And this is going to hurt. We may see a debt spiral at some point. Now, maybe they could try and come back and do more yield curve control, which they did in the past. And if we take a look here, we can see that the U.S. dollar is actually doing quite well relative to the Japanese yen. There's a lot of talk about the U.S. dollar. U.S. dollar's terrible, the country's terrible, the economy's terrible. I think a lot of people are just getting this distorted view because they don't necessarily like Trump, and they pass that on to the investment possibilities. Be careful, because U.S. dollar actually might be the surprise. It comes back and actually starts to rally versus the other world currencies. Japan is right now, we're seeing the yen decrease in value. So the U.S. dollar is going up against the yen. The U.S. dollar is going up against the euro as well right now a little bit. We could see that trend continue. So just be careful with that. I talk about some of the broken signals in the market because we've been focusing on the broken signals, including myself a little bit. I'm guilty of this as well. It's really comes down to really appreciating the amount of liquidity that's being pumped into the markets and the damage that it can do in the long term, but in the short term, it can really throw things off. The first one is the 2-year, 10-year yield curve inversion. So typically in the past, when the curve would invert and then uninvert, so after uninverted, you would find that you would get a recession. So you get the 2-year yield actually yielding more than the 10-year, which is not normal. And that's exactly what we've seen. Well, let's go back into this time period here, and you see this red bar is the recession. So you see our recession take place. The 2-year yield increased past the 10-year yield and then corrected. And when it started to correct, you saw the recession. Same here in this time period. And if we take a look at what's happening right now, we saw this big inversion taking place and then an uninversion. You go, well, no recession. There's something strange that happened. So sometimes you have to look at the mechanics behind what's causing this to take place. And we're seeing all these distortions in the market. This is why it's been really hard to follow certain signals, such as this one. Well, here's part of the answer. So, and I've shown this graph before. This is the duration of the U.S. government debt. Look at this. This is short-term. What we saw is that Janet Yellen, totally irresponsible and reckless, what she did was she shifted these durations to the short term and stacked it all up here. So why did she do that? Because this duration is used as collateral for leveraged positions by hedge funds and institutions. Not these positions, not longer term. That's not what's used for that. Like pensions will invest in this to match their liabilities, etc., or insurance companies, but hedge funds and institutions use this for collateral. So she flooded the market recklessly, and it really helped to provide a lot of liquidity in the market. So they can't do any more, really. I mean, Trump is actually saying over the next 9 months he's going to continue to do this, but we'll see what happens. So that's why the signal got thrown off. The 2- and 10-year signal got thrown off because of what the government was doing in the Treasury Department and how they're allocating their duration. Another signal that really hasn't responded yet, this one still may come back a bit, and I've talked a little bit about this in the past. This is credit spreads, and this graph goes through that. So this yellow line is the S&P 500. This white line down here is credit spreads. Look at the credit spreads here at 2.82%. That's kind of crazy, okay, how low this is. So this is comparison to government debt. So we're looking at high yield debt versus government debt. And for an extra, almost 3%, you're willing to take that risk in this market? Doesn't really make sense. We haven't seen this response taking place. Well, actually, one of the reasons is because of what's happening with the private equity. Private equity is coming in and they're buying a lot of the Russell 2000 companies. They've really run out of companies to buy in the private space. They keep buying things like home HVAC companies or some of the bigger ones, RV parks. They're trying to buy up everything. Investors like private equity because it's very opaque and they pay constant dividends. So they don't really see the true market value of the underlying. And they go, well, that's good. I'm just keep getting paid these dividends. Of course, there could be some surprises down the road, but that's not the point here. And so what I'm saying is the private equity is going in and they're purchasing some of these companies in the Russell 2000 at the weaker end because they're better value for the private equity. So this credit spread is being affected once again. Like it's been a broken signal so far, but nevertheless, I still think if it starts to rise up, it's going to be a valid signal. Business development corporations or companies here, I talk about how we're starting to see this part of the matrix for investments actually starting to show some stress. Okay, so if we look at this graph here, we can see up here we see the credit spreads, okay, basically. And this is, so it's inverted. And then here we're looking at several BDS or BDC companies, okay, or equities that actually trade on the exchange, but this is what they do underneath the actual underlying. So these companies are actually, and I defined it in the previous page of what they do. They go in and they try and help small businesses so they borrow from the banks basically, and then they relend. So there's not so much regulation for these companies. And they try to get extra money from companies or help to support smaller companies along the way. And what we're seeing is this environment, this really get hit hard, where the credit spreads aren't. And so this could be an indication. You can see here that they generally follow each other over time, but this has been a big, huge dislocation. So we could actually see credit spreads start to rise here. In this case, they're inverted, so start to go down. And once again, here's another graph showing the same thing, a little bit closer of a timeline here. And this is once again another graph. This is the S&P 500 as well. So now we're measuring against several metrics. So we're seeing real strain in that side with the BDCs that could actually start to show up in the credit spreads. Okay, so next part of my newsletter, I talk about tariff war, on, off. This is actually a cute little video. It's not a video here. I just posted the pictures. Tariffs are off, tariffs are on. Anybody that's remember watching the cartoons from years ago, this is a little bit of what they would do back and forth. Tariffs are on, tariffs are off, and they'd show this a little bit like a slapstick. What we saw last Friday on October the 10th was we saw Trump respond to China trying to put on export controls on rare earth elements with other countries around the world. So which would really plug up the whole distribution system for rare earth elements. And the U.S. really needs those. And we're seeing this a lot focused in the news. We're seeing the U.S. Government start to take positions in rare earth element companies in the U.S. Just as a background, China has produces 90% of the rare earth elements. Now, they're not rare, but that's just what they're called. It's just a very messy and non-environmentally friendly product to get out of the ground. So China does 70% of the production and 90% of the refining. So actually, they really control this market. Canada actually has a huge amount of rare earth elements as well, but it takes years to greenfield these. And so in any record from Canada in the past, it would take years and years and years. The U.S. is trying to move things along, but there's still a time gap here. And these are critical elements for things like EV cars, missiles, etc. And there's a real national security issue with this. Anyhow, what we saw was Trump come out and really come back at this and say, we're going to put 100% tariffs on China, etc. And here is his post that he made, very extended. I did put up this meme here, and it says, I hold all the cards. It's Trump. And then Xi going, the cards are made in China. That actually applies to this rare earth element situation, which is kind of interesting. We did see that drop take place in the market here on Friday. Interesting, though, one of the things I put this in here is a little bit stale dated, of course, when the newsletter is coming out. But when I was writing, I put this in. But it's interesting to watch what happens. Here's a dynamic that took place on Friday. So here's the S&P 500. These returns are ranked. This is the daily returns on Friday. And if you take a look here, we can see that the consumer staples is actually positive for the day. Utilities was a little bit negative. And we go all the way down the list. So when you see a big downturn in the market in a day, like 2.7% for the S&P 500, really what typically happens is we have in the industry what's called going to one. So everything goes down. So the correlation is negative. Boom. That's not what we saw on Friday. We saw this dispersion taking place, which means that investors still want to be invested. They're not capitulating into this market despite a big drop in the market. To be honest, this response in the market on Friday was more about option structures with the gamma exposure with market makers that really pushed the market down. And that's why we saw, the S&P 500 and the technology sector really get hit. But earlier this week, we're starting to see the market actually pick up here a little bit, as this might have been a one-day event, especially since Trump put out a friendly tweet to Xi. Here's Trump's tweet to Xi. And he's basically saying, look, we're still friends. We'll get over this. You made a mistake. Okay, kind of interesting. They have another round of talks coming up in November. They're supposed to meet. So I think this is more about China trying to flex its muscles and say, look, you know what? You control a lot of the cards, but so do we. We actually have some sway here. And I think this is what's really taking place. China doesn't act on a whim. This is strategically planned. This isn't like they wake up in the morning and go, hey, let's do this. So this is not a quick flash in the pan. They may pull back a little bit, but once again, be strategic here. I look for more non-tariff barriers coming up from China, coming up as part of the flex position, rather than saying, hey, we're going to tariff products coming from the U.S. This is what we're going to do. I also talk about the tariff black swan, a cute little black swan in front of the White House here. It just seems to have faded into the background. In November, we got the Supreme Court decision coming up, November 5th. At least that's the hearing in the Supreme Court, whether Trump's tariffs are constitutionally legal. Courts have found that they are not so far. It isn't about whether tariffs can be put on other countries, it's about how they're being done, because they're being done by emergency order and not through Congress. And that's what the argument is about. I read that 75% chance, according to legal experts, that the tariffs will not be upheld. That's quite a bit, okay? And what that means is that the U.S. would have to return the money to other countries on the tariffs. That would be an absolute disaster taking place and be a huge shock to the market. But Besant and Trump have come along and said, don't worry, we have other plans. We got other tools in the toolbox. I'm not sure what. Are they going to cut countries off at all? And say, we're not going to trade with you unless you donate this money to us, call it a donation. We're going to try something a little different. I'm not sure, but I think we're going to start to see this come in the news more, perhaps later in October or early November. October tends to be a volatile month. Here we did see the VIX pick up here a little bit, going above 20. And here's October longer term. So October is not over. We're seeing a strong market, but a couple days of volatility. But October does tend to be a volatile month, and we'll have to see in the second half to see what happens. Let's take a look at some of the seasonal opportunities at this time. Uranium. I got a little bit of a piece on uranium here. I go in a little bit more detail talking about uranium. Uranium tends to have a strong seasonal period from October 4th until January 24th. And I want to classify right up front, in a strong bull market, a bull market can go right through the seasonal period, right through the unseasonal period, and just keep going, especially with commodities. It's so important to understand that. And we've seen this time and time again, whether it's oil, whether it's uranium, whether it's gold. When there's a bull market, we can see it run much harder than what people expect. In fact, I actually talk about this. I give this a little bit of a writing here and talk about how, a lot of investors are saying, oh, uranium's gone up too much. It's going to pull back. It's going to regress back. They're so used to looking at stocks and saying, well, the PE ratios or whatever their metric they're using, and it's going to pull back. There are some exceptions like NVIDIA, of course, but that's the mentality of a lot of investors. With commodities, they tend to be out of favor for so long that when they do start running, they can run really, really hard and really long. We saw that with uranium going back in 2001 to 2007. That run was huge compared to what we've seen so far. So there could be more to go. And, I talk about what's taking place as far as that goes in this writing here. As far as the chart, I'm using URA for uranium here. We did see this rally really from April into September. Then we saw this consolidation take place. And this is very typical of a bull market. You see a rally take place, a consolidation, another rally. In fact, there's a mini consolidation, and we're seeing uranium run again. Stocks, you'll typically see some sort of a rally, a correction take place, and then another rally, and then a correction as well. you tend to find more consolidations in bull markets for commodities. So this is a positive sign, and we keep seeing uranium move higher here. It's very interesting. So we could see it continue to move higher. So we're in the strong seasonal period for uranium. So why is this a strong seasonal period for uranium? Typically, we find the uranium companies start to change their attitude, start to do their purchases after the World Nuclear Association conference in September. And that's sort of what we saw this year a little bit, with uranium actually having a second leg higher. Now, uranium typically doesn't do well in this summer period, but yet we saw that do extremely well, which is a sign of strength over the longer term. So this is actually a good sign. I put Cameco on here just due to stock here. We saw the same type of consolidation taking place. We're seeing the same pattern for Cameco versus the overall sector. Obviously, the magnitude of change is going to be different with a single company as well, and issues or positives for the company. But the same general trend taking place. The reason why I did this is because I wanted to show you the seasonal trend for Cameco. Okay, so this is actually on my website, alphamountain.com. It's on the last tab called Seasonal Graphs. I've got a bunch of seasonal trends up there. I'm actually going to build this up a little more. I got to spend some time on that. But here's Cameco over a long period of time. You can see here that November is the strongest month of the year on an average basis, that's the blue bar, and a median basis, which is the cross here. So yes, uranium has gone up a lot. We haven't even hit the strongest month of the year yet. So we could see uranium go up a lot more here. And look at the frequency here. Once again, November, it's got the highest frequency of positive performance. Doesn't mean it's going to happen this year, but it is a tailwind for Cameco and also the uranium sector. We've seen the metals and mining sector perform well. And this is important too, because when this sector performs well, this actually gives the boost to the uranium sector. It'd be really strange to find the uranium sector not performing well when we're seeing the metals and mining sector on fire. So there is a correlation between them. If the market's moving up positive and you've got the metals and mining sector moving up, that really does give the uranium a boost outside of the positive events that are happening to the uranium sector. And, my writing on uranium on the last page, I talk about you can't necessarily wait around for the positive news for uranium. It's all good. There is no negative news coming out. The only positive news is going to move uranium if it's huge. If it's really big, yes, it can have an impact, like the White House making a huge recommendation or something of that nature. But we already know what the supply-demand situation is in the future. We know there's going to be a deficit. We know all this. So it really comes down to investors actually changing their tune. And it's whether now the utility companies are now switching from doing a lot of their purchasing on spot price to longer term contracts, which would actually help to boost the price of uranium as well. So and that's actually been happening a little bit here. We might be at that inflection point. So those type of factors can actually help to move the uranium higher as well. But going back to metals and mining here, the sector's done really well, partly because of tariffs. I mean, if you take a look, that's going to help this sector overall. A lot of these companies are U.S., and even if they're not, the real draw line would be with companies that are on the other side of the tariffs here. And we're seeing the metals and mining sector do extremely well. And typically, you don't see this in the summer months at all. This has been the stealth bull market that nobody's really noticed how well this has done. And this has been one of the reasons why we've seen the TSX, the Canadian stock market, do well. Canadian banks have done well, plus also to the metals and mining sector. If we go down and take a look at industrials, really have been consolidating. They've been underperforming here, but they're back to this baseline relative to the S&P 500. So we might actually start to see this bounce higher here. The focus has been on technology, but given that we've come back to this overall line here and this pullback here, we are seeing economic reports from around the world actually a little bit stronger than expected as well. Now, maybe that changes, and that could help to push the sector higher. I also show the material sector, XLB in the States, which is very different than the material sector in Canada. This is mainly chemicals. So it tends to operate with the industrial sector as well, very close to it. But look at this, really weak performance over the last few years. Down relative to the S&P 500. But look at this. Here's the left shoulder, here's the head, and here's the right shoulder. It hasn't completed this. It's only if it crosses this line right here does it become valid. So let's hope it goes up here rather than down. Otherwise, we could see some trouble for this sector. And if we take a look, here's agriculture. Agriculture typically does well at this time of year, but it's actually broken down. It's been consolidating and it's had this breakdown taking place. The agriculture sector does have a correlation with the industrial sector. So when the industrial sector is not performing well, it tends to underperform as well. There's a cross between the two sectors as well. There's a lot of the ag sector. It's not just grains necessarily. And in here, in this particular ETF in particular, would be things like Caterpillar, Deere, that make products for both the commercial and agriculture sector as well. With industrials not performing well, that's has an impact on the agriculture sector. Energy. Look, we're a long ways away from the start of the seasonal period for energy, but this could be a good one down the road. It starts in February, but if the energy sector does really is at a weak point, sometimes we can actually see that take place, the bottom in late December. Something to keep an eye on. This energy sector relative to the broad market has just been performing very poorly, but that could change. We're still a ways away from that. Okay, here's gold on fire, starting to make a lot of the news. Okay, it actually ended its strong seasonal period on October 9th and remains strong. So even though it's overbought, it hasn't shown any signs of weakening. If we take a look at the gold graph, it's exactly what I talked about with uranium. We see consolidation, rally, consolidation, rally, consolidation, rally again, consolidation, and rally. And we've seen this going on fire here. So yes, central banks continue to buy, but I think it's more than that. We're seeing governments really act recklessly and irresponsibly. They just keep on spending money. They think they have the solution for the economy, whether it's Japan, whether it's Europe, whether it's the US or Canada. They're all being irresponsible and say, we have the solution. We can help. There's a crisis, and we're going to spend money so the economy can grow. We're going to invest for the future. Well, it just doesn't work that way. We know that. We've seen this time and time again. And as a result, this is really what's called, and starting to get the narratives gripping the market. You're going to see more of this in the future, what's called the debasement trade. And that's really about the currency, that there's going to be more printing of currency down the road. In fact, the Federal Reserve, Powell, just came out the other day and said, well, maybe we're going to stop QT. Remember, they really slowed QT down, okay, so on the Federal Reserve balance sheet. And it's really small right now, but they're still doing it. It's still really high. I think it's around high $6 trillion. That was just crazy what they did, buying things like mortgage-backed securities when there's a housing bubble. It was just absolutely insane. They still have a lot of mortgage-backed securities, which is interesting. They should never have done that. But anyhow, investors are saying, well, we think this is going to continue. We're going to keep seeing money printing here down the road, et cetera, so that we have to protect ourselves. And so that's why they're talking about the debasement trade, and gold's been doing well. Silver actually has been doing better than gold. That's this bottom panel here. And we're seeing silver take off. Here I talk about the Canadian dollar. And I actually did a short video. If you click on this picture here, it's like a 2-minute video, and I talk about the Canadian dollar. Right now, we're seeing the Canadian dollar underperform the US dollar, and that's really been taking place since June, which is interesting because world currencies have actually been doing okay relative to the Canadian dollar until very recently. We're starting to see a pickup in US dollar strength, which could be the wrecking ball that could hurt risk assets if we see this continue with the U.S. dollar. I think it's not so much the U.S. dollar is picking up strength. I think, we've got Japan saying, hey, we're going to spend a lot more money. We got France, which is in huge economic problems, may have to seek an IMF solution. We got UK, which is an economic basket case. Germany is now running into all sorts of problems as well. So if Europe's not doing well and Japan's not doing well, it's really the U.S. dollar on a relative basis might be the cleanest shirt in the dirty laundry. That, as far as that saying goes. But this here, the Canadian dollar heading lower, it's partly because we've seen oil price go down. Our dollar, the Canadian dollar, is affected by the oil price, but really we're not seeing any really pro-growth policies yet that encourage businesses to locate in Canada. And to help grow the economy. And so we're seeing a stagnant economy. We've seen this for a number of years, and investors are a little bit tired of waiting, I think, and that's what's happening. We're seeing the Canadian dollar move lower. Let's take a look at the tech sector. If you remember, I've done a little video in my last newsletter. I talked about this. It looked like the tech sector was rolling over. We did see how get a second life here when risk on took place, and so it's actually doing quite well here. We got the second life relative to the S&P 500. That can happen. It is in a strong seasonal period, which runs really into early December. And it tends to take a pause until later in December. So as long as the market remains risk on here, we could see this sector actually do okay over the next little bit. Consumer discretionary sector update. If you take a look, really, we've really over the last while, it's been equal to the market, but we have seen this pullback relative to the market and come down to this line here. I would not be surprised to see a bounce take place for this sector over the next couple of months here. So it could actually do well. Let's take a look at consumer staples. And really on an absolute basis, it's gone nowhere over the last, let's take a look over a year and a half. And we've seen this underperformance relative to the S&P 500. But watch out, we're down at the bottom of this channel here, and we're starting to show this pickup here a little bit for this sector. Why is this important? October tends to be a stronger month for consumer staples. And we're starting to see a little bit of a pickup. And investors want to stay invested, especially if volatility picks up. We may see investors start to get attracted to the consumer staples sector. Okay, Canadian banks. If we take a look at Canadian banks have done very well, even outside the strong seasonal period. The reason being is they pay a high dividend when there's uncertainty in the markets, but a recession is not imminent. Investors get attracted to the Canadian banking sector. It's just how that works. They really rotate into the sector. And it's only when the possibility of a recession really starts to creep up do investors start to leave this sector and avoid it. But that's not what we've seen. We've seen Canadian banks do okay here. We're starting the strong seasonal period. It lasts until December here. So we could actually see Canadian banks continue to perform well. But watch out, they are getting richly valued. And especially if they come out with strong earnings coming up at the end of November when they release their earnings, we could see December start to be a little bit weak. And I'm going to write about more of that in the next newsletter as well. Okay, it's rant time. My first rant is the Federal Reserve producing a paper that said that the U.S. could, in fact, have a U.S. government debt to GDP ratio of 250%. Yes, you heard that correctly. 250%, and it would be inconsequential. It wouldn't move interest rates. I really don't know. I mean, there's 900 PhDs in the Federal Reserve, and this is like really absolutely unbelievable they would actually think this. We're seeing this to be an absolute joke, actually, at the time. Now, this was actually just when in the Jackson Hole meeting that was taking place back in August. Here, I've just put this up now. This had somehow slipped by, but I just wanted to bring this out to show you that perhaps if they're coming up with this conclusion and we're seeing the exact opposite of this taking place right now, the U.S. has a U.S. debt to GDP ratio of 119%, and they're saying they could double it. More than double it, and everything would be just fine. This is a bit of a joke. We're seeing investors around the world saying, right now, with the U.S. debt to GDP and the Japanese situation, the German, everywhere, France, all the yields are moving up higher because they're saying we don't trust the governments. We think they're going to continue to spend money and to raise money and devalue the currencies over time. So yes, there are consequences, and that's actually happening now. My point here is that if this is what they come up with in this environment, maybe some of their other work really isn't relevant here because 250%, it just will absolutely crush America. Here's my rant on the EU. I've written about the EU in the past so many times. I'm not a fan of the EU structure. This has really hurt countries over the long term. A lot of people living in the EU don't think it's a good institution. It's undemocratic, et cetera, and they really believe in an over-regulated society. And so I saw this meme and I had to put it in, the EU economy, and basically here we have somebody saying that perhaps we need more regulation. Yeah, okay. This is really the way they think. And it's unfortunate, but it's possible we could actually see the EU really as a structure really run into trouble here coming up shortly. Here's my rant on Canada's PBO, coming out with words such as stupefying, shocking, and unsustainable. This is Canada's PBO interim person who has actually come out and saying our debt situation in Canada is really bad. We need to get control over this. I'm not going to get into politics of this at all, but I actually agree we have a problem. And it's not just government debt, it's private debt. We're one of the highest private debt in the world. We got corporate debt. Canada as a country has a huge debt problem. But I do want to point out here the one thing here. So I've put up a graph here of Canada's debt to GDP, and this is from the IMF, which is the international standard. Canada's current debt, gross government debt, is 111% compared to GDP. You'll hear a lot of politicians banter around. It doesn't matter if it's the Conservatives or the Liberals. They've all done it in the past. Talk about net federal debt of being in the 40%. It's irrelevant. I'm not going to go through the whole structure of how they count that for that. But the international standard is the gross government debt, which is what really matters here. So Canada does have a debt problem. We need to solve this, and we need to lower it. And anyhow, I'll just leave that there. I couldn't help myself with this rant here. Here's a lady in San Francisco. She she selects your baby name for $30,000. Yes, this is often a sign of craziness. And when the markets are perhaps a little bit stupid, you get this type of behavior. Here's my plug-in rant. When I say plug-in rant, so initially George Gammon had posted this on X, talking about how the AI companies and the hyperscalers were all starting to invest in each other. I couldn't help myself but to put up a meme here of an extension cord plugging into itself, because that's sort of what's happening. Then we found out that, in fact, it keeps going deeper and deeper. And look, I'm not trying to downplay any of these companies, but it's kind of crazy with what they're doing here. You've got NVIDIA investing into OpenAI investing in Oracle into NVIDIA, and it's continued since this came out. Intel's involved, AMD's involved, and they're all investing in each other. Perhaps there's a bit too much cash right now that can be used in this market if this is taking place. But it is helping to drive up the valuations overall of these companies at the same time, which is kind of crazy. Anyhow, thank you very much for joining me today with the newsletter video format. If you like this video, please click on the like button and consider subscribing as well. Thank you very much.